Good morning, everybody. Kirk Spano, and it is one day until the Super Bowl. Who's going to win, the Chiefs or the 49ers? I have no idea, but I thought it was fun that there is an article, as there is every year, about the Super Bowl indicator and what it means for the stock market. And the answer is pretty much nothing. There were a few years where it looked like there was a trend. If the NFC team would win, or if a team that would win that was never in the original AFC lost, it would have an impact on the stock market. And what we have found is, like a lot of silly things that have a coincidence to the stock market, doesn't matter. And the data sets were too small to begin with. And that's a pretty important theme with investing, is that the data sets that are out there often don't really matter very much because there just isn't a depth in the statistical analysis to really give some of the things that people attribute to the stock market as having really any credibility. Now, we're going to talk a little bit about things. And the first thing we're going to talk about is inflation. I talk all the time about how there are inflationistas out there who point to inflation and they point to inflation and they point to inflation as being the big boogeyman. But as you can see, except for a couple of periods, inflation really has been pretty moderate for a very long time. Came down tremendously after the oil embargoes. Right? Really, this inflation was caused by oil. And then ever since we fixed the oil problem, inflation has stayed relatively low and came down precipitously after about 1990. We had deflation periodically here and here and here. And that really has been since the financial crisis during the Great Recession. So if we have trended towards deflation the last 15 years, what does that tell you? Well, after an inflationary period in the 50s, 60s, and then 70s, culminating in oil shocks, inflation plunging on monetary policy, coming down, flirting with getting very low, and then crashing and twice hitting deflationary levels, what should the big takeaway be? The big takeaway should be that here, the financial crisis, the Great Recession, is the pivot point from disinflationary and inflationary periods to more deflationary and, in most cases, disinflationary, but deflationary and disinflationary versus inflationary and disinflationary. Disinflationary meaning less inflation. A couple of years ago, I said that inflation would be transitory, but that most price levels would be the same, that they would not come down. So we have seen inflation crash, as I told you that it would, and we are going to get a lot of disinflationary forces on the economy in coming years as AI and clean energy take hold. In the very short term, clean energy is inflationary as we build it out, but once it is built out and adopted, it becomes very disinflationary or even deflationary if our energy becomes very, very cheap in the 2030s, which is what is lining up. So all the people who thump their chest about, oh, this is it, this is the big inflationary spike. Well, look here. It's a much lower peak, isn't it? So over time, the peaks have gotten lower and lower over the last 100 years. And I would expect that that would continue based on the demographics and based on the technology. So everybody who thumps their chest and decides that they want to tell you how important it is that you plan for inflation, they're pretty much full of shit, and they've been full of shit a very long time. This period pretty much points it out, and this period, financial crisis and Great Recession, is the pivot point, because at that point we unwound a lot of leverage, and really the baby boomers started to retire. And there's a statistic in this week's Forest for the Trees that I will point out in just a couple of minutes that has an explanation that they completely gloss over. And I will explain it for you. This week's Barron's, if you don't subscribe to Barron's and Wall Street Journal bundle, where you get the Wall Street Journal and Barron's and Market Watch, you really should. This week's Barron's is just fantastic. I was reading it this morning while I watched Bloomberg's Wall Street This Week, or This Week on Wall Street, whatever they call the show, and just article after article that I thought was very important. Here's one, and you'll remember this from a month ago. What did I talk about what happened to stocks as interest rates started to come down? people are starting to move their cash off the sidelines. It's very early in the process, but as interest rates come down, either in March or May, starting to lead towards May, and I'll explain that in just a second why. But as cash comes off the sidelines, other assets go up in price. S&P 500 is rallying still. 5 weeks in a row it's been up, and we are over 5,000 now on the S&P 500. That is in line with my article at the start of the year that the stock market will see a rally, and then angst, and then euphoria. When do we get the angst? It makes sense that things play out in a way that is consistent with what the Federal Reserve and the U.S. Treasury want. And I think that as we go through the tree rings article really quickly today, some things should become apparent that I've been talking about for a while now. First, I'd like to just point out, though, David Einhorn gave an interview where he basically said the markets are fundamentally broken, mainly because of indexing and quantitative trading. What have I talked to you about 1,000 times by now? The indexers are a little over half of all stock market inflows at this point. And that means that the mega caps continue to get inflows, even though they're overvalued. They're not overvalued a lot because they're that good of businesses. However, Tesla is the exception, I think. Their stock price is being held up by the index inflows because the people who have been the religious with Tesla have slowly cashed out because they wanted to buy a mansion or whatever it was they wanted to do. And new Tesla believers have been slow to develop, mainly because the people who buy Fords and Toyotas and GMs and Volkswagens and Volvos and everything else and BMWs and Mercedes, that's what they buy. So to convince them to buy Tesla stock, you almost have to convince them to buy a Tesla. And they're not really likely to do it. So Tesla's early mover advantage has not and probably will not translate into being the number one car producer. And I think it's going to be very hard to overtake Volkswagen. Ford maybe has an outside chance, so does Toyota, but Tesla is probably not going to crack the top 5. So in that world where Tesla probably doesn't crack the top 5 for auto sales, why would they be the most valuable car maker? Well, early mover advantage, the people who believed in it, who treated it like religion. And now when it was big, the indexes supported it. However, as people trickle out, the indexes support it less. Why? Because they're a smaller market cap. So there's this relationship between indexers and people who actually try to invest based on value or growth that plays out. And Tesla is really a great example because the indexers don't have enough money to support it if there's not also new buyers on the other side of the equation. So half of the people are indexers, half of the people are stock pickers. If the stock pickers aren't buying it at all, it really becomes a sell the rip stock. So the next time that Tesla has a run up because the market's doing well, it's probably a great time to sell. And it will just keep coming down in steps on market cap, or as I've suggested, might just chop for a very long time. And it probably is a great trading stock. I know Shooter loves it for trading, but I don't see it having $2 trillion potential. In fact, that $500 billion is about probably where it belongs in the very long term. And since it's really almost there, just limits its upside. And when you put into context how indexing versus stock picking works, and the fact that the machines are generating so much of the day-to-day movements, even though they only move maybe 1% of the stock, pricing at the margins, which we've talked about and is a basic economic concept, the movement at the margin is what changes price. So Einhorn has changed his investment strategy, and it's worked the last couple of years, but really hasn't outperformed. And I'll just tell you, an article that I'm going to write soon is that the winning algorithm, if you were going to invest based on an algorithm, it would look like this. You'd be buying growth stocks when they're cheap and then holding them until a FOMO develops. That's really been the philosophy behind all the small cap stocks that I've been buying. They've been super depressed. There was a huge sell-off in the SPACs and then the small caps in general and the micro caps. And you could buy these growth stocks for book value in many cases. Well, when you buy anything for growth value, if it has any growth at all, you're probably going to make money in the long run. However, 1 or 2 years can look bad. But when those stocks start going up, they start going up in big, big chunks. And we're going to talk more about that on Monday. But as you've seen in the past week, several of our stocks jumped huge on their earnings announcements because they finally hit those pivot points on profitability. Spire Global up 25%. Palantir up 25%. Some of the other stocks that we're in up 25% in just a week or two. It's starting to look like we bottom ticked Teladoc. I still think that we probably bottom ticked Ametis, even though it's off of its highs. And when you start to take a look at these companies based on the real metrics, and then you project out the growth, and you realize that the downside for most of them is that if interest rates stay higher for longer, they just have a little bit of dilution or a little bit more interest expense, but the business keeps ticking along, you realize your downside is limited. But your upside is still multiples, 5x and 10x, and sometimes 20, 30, 40, 50x. So you can chase companies like Tesla or other not mega cap stocks, right? Not the biggest trillion-dollar stocks, but those stocks in the S&P 500 that get some support from the index, but not enough to offset a bad business or a business that stops growing in the long term. You find that those day-to-day movements just don't matter that much. They're tradable, and your Elliott waves or your quantitative analysis can win sometimes, but the problem is that the quantitative traders in the very short term are so powerful. They move such big piles of money that all you can really do is try to grab onto them the way those little fish grab onto the bottom of a shark. The shark is the predator. What do you call those little fish? The pilot fish that grab onto them, and they have another name besides pilot fish. Traders are the pilot fish to the shark, and the really good traders can grab that shark when it changes direction and then ride it until right before it changes direction again, or maybe jump off as it spins around. But don't ever think that you're a shark. If you think that you're a shark, you're delusional. You're a pilot fish, and you're doing your best, if you're a trader, to grab onto the shark as it's moving and jumping off when it changes directions and then jumping back on. The machines, quantitative trading machines that are run by the citadels of the world, can eat you. And if you get flipped off that shark and it turns around, you're dinner. And that's why I try to tell people, unless you are very committed to it, don't trade much. Try to get involved with growth companies trading at value prices, which is easy to do right now if you're willing to buy micro caps and small caps and some mid caps, and then you wait for the FOMO rallies. And I believe that your FOMO rallies are going to happen from now and into next year. I'm not very convinced, and I'll talk about this for the very first time today, I'm not very convinced that the market looks great in 26 and 27 and 28. In fact, if we're going to get a big recession and stock market crash, I think it comes in that time frame. But for the next year or two, really, I think until January of 2026 would be my guess, when people start selling in a new tax year, like they did this year for a couple of minutes, you probably have almost 2 years of rally left. And 2025 will become choppy at some point. But from now until the first quarter of next year, man, I tell you what, this looks like an environment where a lot of things can go right and not many things can go wrong. And if you go through the checklist from monetary policy to fiscal policy to China easing to a lot of people in the market liking the idea that Trump might win, to the fact that the Biden administration through Janet Yellen and the Treasury is working on ways to stimulate, to the residual value of all the bailouts and all the stimulus, to all the cash on the sidelines that as interest rates come down will move back into risk assets, you really see 2024 and 2025 being pretty attractive. I don't know what's going to happen after that. I suspect we get a snapback. I believe when the tax cuts expire, which they mostly will, even if Trump wins, is going to be a drag on the economy short term, not because there will be much less spending, but because if the United States moves towards a balanced budget in 26 and 27, and obviously we won't get all the way there, but if we move in that direction, because some of the tax cuts expire, and remember, the tax cuts under Trump and Bush are about 85% of the deficit. New spending over the last 20 plus years really doesn't account for much of the deficit. The deficit is almost exclusively driven by the big Trump and Bush tax cuts. Without those tax cuts, we're basically at a balanced budget. And since the budget, you can look at two different ways, with Social Security and Medicare or without Social Security and Medicare, you start to realize there really isn't much fat to cut in the US budget. Can't cut Social Security and Medicare. You can talk about it. It's dumb to talk about it because Social Security is the subsistence living paycheck that most Americans actually need to make it through retirement. 80% of Americans don't have much retirement savings. Most people have some retirement savings if they've worked, but I can't tell you how many times people come to me and say, hey, I want to retire at 62 and I have $147,000 in my 401k, so I feel pretty good. Blows my mind. Anybody who thinks they can retire early on six figures had better be moving to a country where the cost of living is about a third of what it is in the United States. And those countries don't really exist anymore. And the ones that do, you probably don't want to live in. So if you look at the US budget from the standpoint of with Social Security and Medicare, you realize, okay, can't really cut that. Let's just take that out of the equation then. And when you look at the deficit, it really isn't based on Social Security and Medicare because those are standalone items. Deficit comes from the regular federal budget, which is about half defense spending, and then half everything else. So if we're running a deficit of 6 or 7%, meaning that for every dollar of tax revenue, we're spending $1.06 or $1.07, what can you cut? Well, if half of that $1.07 is defense, could cut defense 7 cents, but who wants to do that, and especially in an election year? I think in the long run, the defense budget has to be completely flat for about a decade, but I don't know who has the guts to vote for that. So they talk about cutting the education department and the Health and Human Services Department and everything else that's out there, but not defense. The problem is that virtually every other administration within the federal government is already short of staff and technology. Take a look at the IRS. President Biden tried to fix the IRS with new technology and a little bit of manpower, and the Republicans went crazy about that. And they started saying, oh, everybody's going to get audited, which is crap. I've gotten 2 letters from the IRS in 20 plus years of running small businesses. I'm the most likely person to get audited, and I haven't gotten audited. The IRS doesn't have the technology or the people. It looks like it's moving towards having the technology and maybe won't need a lot more people. So we'll see. AI probably makes the IRS and the rest of the government a lot more efficient. If we can hold the line on raising expenses anywhere else in the government other than defense, and then just flatten defense, and some of the tax cuts expire, and we do the minor changes to Social Security and Medicare that we need, really they are minor, it becomes easier to see what I've been saying for a long time now, that we probably move towards balanced budgets in the 2030s as baby boomers start to pass away. Between now and the 2030s, they're going to retire. And that is one of the things that they talk about over here at Tree Rings without talking about it. So in this week's Tree Rings report, Liz Ann Saunders talked about how 1.4 million full-time jobs have disappeared from the workforce in the last 3 months. What have we been talking about for quite a while? Is that the baby boomers are retiring at a pretty high clip, probably going to be 3 to 4 million retirees each year through around 2030. They look through things through that Austrian economist viewpoint that I harp about all the time, that tries to focus on the cycles over the secular realities. And what I have tried to preach to you is that you can trade the cycles, but you need to understand the secular realities that they live within. Well, the secular reality is that the boomers are going to be retired en masse for about another decade. So the full-time workforce shrink is really tied to boomers retiring. This isn't a cyclical thing. They attribute it to cyclical ideas, and then it colors the rest of their analysis to be partially wrong. Not completely wrong, because you can see the cycles in the charts, in the comparisons to history. You can know about where we are. But when you overlay that with a secular trend, imagine a line that's equilibrium, and you have to figure out, okay, is this cycle above or below? Is the choppiness indicative of a down period that's going to be permanent? Or is it just a chop around a line that you have to identify? And a lot of people anticipate and believe that growth is forever. Well, the problem with that is that we know that it's not. And we also know that disinflation makes growth lower. So if the equilibrium line isn't straight or up to the right and starts to bend down a little bit, you get deflationary pressures. And the pressures are, for the most part, deflationary for decades from here on out. That pivot point on the inflation chart that I showed you makes it very clear that the recent inflation was transitory, that the boogeyman is deflation, and that the counter-secular policy, not counter-cyclical, is what to focus on. Counter-cyclical policy implies that we are in a growth age with supportive demographics, supportive debt, and technology that doesn't really impact the inflationary outlook. And all of those things are wrong. And that's why the inflationistas have been wrong for so long, for over 40 years now. And during that one little uptick of inflation, which was completely brought on by the response to COVID, which is a one-off that we probably won't see again in our lifetimes, hopefully, we can see that the return to normal, which PIMCO called the new normal about 12, 15 years ago, is really where we are. And the new normal is deflation and disinflation versus inflation and disinflation. We've gotten to the other side of the hump. And that means that central banks around the world are going to have to be supportive until that flattens out again. It starts to head back in the other direction, which it may never do. With the exception of short bouts of inflation that can be brought on by massive deglobalization, not the little deglobalization that we're seeing now. The deglobalization that we're seeing now is around the edges. Gigantic deglobalization would come from a world war, in which case you've got bigger problems. Can't plan for a world war and a Great Depression. And you shouldn't, at least not with your portfolio. If you want to build a house like me with an egress and a nice big safe, go ahead and do that. If you want to have a big gun collection, I think it's a waste of money because the zombies are going to get you no matter what. If you've not watched TV, the best tool you have to protect yourself against whatever financially can happen in the world is just to have more money. There's a saying in poker, scared money don't make money. I think there's a lot of truth to that, as long as you don't get reckless. As long as you don't get reckless. The gamblers that I run into in casinos, I was just in Vegas again this week for my birthday. We went to the Venetian, played some poker, told my buddies and my son, hey, when you walk into this room, you're going to see two things: oil guys and professional poker players, and then everybody else like us. I sat next to $2 million plus winners in the tournament I was in and two oil guys, all on the same table. The way they gambled was different. Each person was different. But the one that was splashing around, just wanted to throw his money around, probably compensating for something, he lost. Person who selectively took gambles that were likely to pay off, but without risking much money when they were doing it, they won. One of the gamblers got me twice. I had aces once and kings once. I lost to queen 3 and to king 4. It happens. It won't happen often. Sometimes the gamblers get paid off. But for the most part, playing your good cards, like sticking with your best stocks, and being in the right asset allocation was going to pay off. So where does your asset allocation come from right now? It should come from the idea that we are in a deflationary and disinflationary secular environment, that any periods of inflation are temporary, caused by something. In this last case, it was COVID, which completely shut down the economy and the supply chains, blew up the oil market, and within 3 years, it was fixed. And I understand that for most of us, that's 3 or 4 or 5% of our lifetime. So it seems like an eternity. But the reality is that this inflation was transitory. The people who mock that are know-nothings, they're flunkies, or they fall into the meatloaf camp of they get 2 out of 3 things right and they think that's not bad. As you watch the stocks that we've decided to hang on to, what you're going to see is that we have some break-even stocks. The losing stocks, we've pretty much gotten rid of all of them. And almost everything's going to win if it doesn't break even. I mean, we might get surprised by 1 or 2 that lose, but we'll dump those too for small losses. Just like the poker player doesn't throw all his chips into the middle and say, let's get a card. So what are some of the highlights here that I want to focus on? One, they talk about Bitcoin quite a bit, and I agree. One of the things they talk about here is that wages look like they're set to have another rally. And I do think wages will drift up because I don't think the economy is going to get tight quite yet. But historically, 6 to 12 months after rate cuts begin is actually when we get the recession. It's counterintuitive, but that's the way it works. The Fed tightens into a strong economy. The strong economy stays strong. And then when the Fed starts to see the cracks, they cut. and the economy finally turns over because the prior tightening finally has an impact. I think this cycle will be a little bit delayed, a little bit manipulated, but ultimately the recession and the correction will play out. I just don't think it's until 2026 or 2027, which will coincide with that big energy shift that we've been talking about. So a lot of things are at play now to keep the market up, make risk assets attractive in the short run, and to let a rally play out into 2025. One of those things is going to be cutting interest rates. Here, they argue that interest rates won't get cut as much because wages are going to go up. That's a cyclical thought by an Austrian economist who doesn't realize or is unwilling to admit, for political reasons, that wages in the United States on a real level stagnated for 40 years after Ronald Reagan busted the union. So real wages in the United States did not go up from the early 1980s until after COVID. It took the shock of COVID to cause wages to go up much. And now, as inflation comes down, if wages go up a point or two, that would be the real wage gains that people have been begging for decades. And yet some people complain about it because, oh my God, maybe something bad will come of it. Let me ask you again, as I've asked you in the past, do any of you want lower wages? Pretty easy to answer, isn't it? So right now, what's going on, and we've talked about this since I brought up some of those private equity investments, is the senior loan officers, and there's a survey for that, at banks are starting to loosen up credit standards. Remember about a year and a half ago, 2 years ago, I told you that everybody was throwing credit at me, had like $100,000 of credit card limit added. They just kept giving it to me. And I said that'll turn around. And sure enough, it did. Over the last year, actually, one of my credit limits got lowered, like $700. It was a dumb thing for them to do. Clearly an algorithm or some quantitative formula, just, doing whatever it does. When loan conditions become looser, typically wages go up a little bit and the stock market grows. And we are at a point now where the SLOOS is going to be very slightly inflationary, but into the big disinflationary trend and the deflationary trends that are secular. So all it's going to be is a small offset. The idea that it'll push interest rates higher or hold interest rates higher doesn't take into account something that these guys have been talking about anyway, which is that the banks need the money. And Janet Yellen, if you've been watching the news, has been talking about that. Janet Yellen actually had a quote this week where she said, it's pretty clear at this point that the banks are going to have a problem that's going to have to be fixed because of commercial real estate. So out of one side of tree rings, they're saying, hey, inflationary pressure, higher interest rates. Now, the other side, they're saying banks need the money, got to lower interest rates, got to loosen things up. And the bank officers are already saying they're going to be loosening things up. What do you want to believe? Let's touch on a couple other things because I'm going to be putting out the Global Trends ETF later today. I don't talk about gold very much, but I did mention it last week. So I want to talk a little bit about gold because in China, and they really have a lot of quotes for gold here. There you go. You had a lot of people, because of the real estate crisis there, switch from real estate to gold investments. How much so did they do that? The shift from real estate to gold in China took up roughly 100% of the annual gold production this year, meaning no new additions to inventory. And in fact, this is the chart that I really like. The gold in ETFs has been falling. Why is that? A couple reasons. What is one of the big reasons? One word, starts with bit, rhymes with coin, right? The millennials and even the Xers like me and the Gen Zers, they're not buying gold ETFs. And despite that, the price of gold has gone up, mainly because the Chinese were buying gold. What animal does this look like opening its mouth, right? We talk about alligator jaws all the time. What happens with alligator jaws? They close. Now, it doesn't mean that the price of gold is going to come way down here. And it doesn't mean that gold ETFs are going to see a ton more assets. But what it might mean is that we see a little bit more assets in gold ETFs, but probably at some point, the price stops going up. And over a long period of time, maybe a few years, you could see these lines meet back up in here somewhere. The offset, however, is the secular problem that we're producing a lot less gold. So on the cyclical side, you can see that these should snap shut. This probably going up, this probably coming down, which is counterintuitive, right? Because if demand for gold and ETFs goes up, you'd expect the price of gold to go up. Maybe it does, but the price doesn't go up as fast. What happens if the price of gold goes up a little bit and all those people who are buying gold are profitable in China and the price of property there gets cheap? What will be the natural reaction for them? Sell gold to buy the cheap real estate. Sell the expensive gold to buy the cheap real estate, right? So the cycles aren't so easy to understand unless you parse out the key components. And the key component in the last couple of years for a rise in gold price has been, one, in India, they've been accumulating gold. They normally do. But suddenly China did it too. Not only at the central bank level, but individuals. Essentially, China taking up all of the gold demand, Chinese gold demand taking up all of the global supply for a year. I don't expect this line to go down as steeply as it has been in the future, but I do think it's going to continue to decline until it's at these levels. So in the future, you're going to see it out here. And as the Chinese sell gold at some point in the future, which they will to buy property, and the central bank and the central government of China, the commies, they can create the conditions for that, right? They write the rules. So what they could say is, if you sell gold, we won't tax you on it if you turn that money into real estate. So the idea that China has to collapse, the Kyle Bass theories, is wrong. Why am I talking about this? Because right now, the United States and China are engaged in pretty high-level negotiations on letting the yuan appreciate against the dollar a little bit. The problem is nobody trusts the Chinese, so it's really going to have to come from the dollar getting a little bit weaker. Intermixed with that is the idea that both economies want to protect themselves. The United States wants to stay at full employment. They want to be less reliant on Chinese output and imports. So industrial policy plays into this, reshoring. President Biden, President Xi had a meeting in San Francisco a while back. Suddenly, the dollar lost a little bit of strength. So let's talk about the timing of what's coming. Because if you read what's on the tea leaves right now, it's pretty clear the dollar is going to drift down, but there might be one more strong dollar moment. I talked about a strong dollar moment last July, and then we got it in the fall. And I think there will be one more strong dollar moment maybe in March, April, and May. And then from that point on, you'll start to see the dollar drift down, or maybe even take a big step down, depending on what the Federal Reserve decides to do. We know that tax receipts are going to be high through April, and that's why the projections of how many treasuries have to be sold have come down, not up. But those tax receipts are going to tail off in May. And of course, we're already seeing the impact of commercial real estate, with New York Community Bank Corp being the harbinger of what is to come for a lot of other banks. It was last March that the banks ran into a problem. I think that time frame is relatively consistent. We've seen a lot of bank issues come up in the spring. It has to do with how they run their balance sheets, how deferrals work, how taxes work, everything. It just all kind of plays into banks tend to have problems in the spring. Bear Stearns funds had their problems in late winter and spring. The 3 banks collapsed last March. So it wouldn't be unusual for March to be a bad bank month. So somewhere between March and May, 2 Fed meetings, probably when we get our interest rate cuts. And Chairman Powell has already told you that they're going to start winding down quantitative tightening. We'll give you the details in March. Those are known things. Those are not unknowns. Those are knowns. So rather than worrying about the unknown unknowns, focus on what we know. What we know is that the banks need money. What we know is that the Fed is going to give it to them. What we know is that the Treasury is going to need more institutions and organizations to buy treasuries after the tax receipts fall. That happens in May. So in March, you're going to find out that quantitative tightening is getting wound down, probably starting in April, maybe even starting in March. As we go into the period when tax receipts fall and commercial realty stress on the banks increases, and all this folds out into election season. You're going to get your moment of angst sometime between now and May, I would think. And if we do, you'll want to get fully invested. I only have a single-digit percentage in cash right now. I did a little trimming last week from my cell phone, so maybe 8 or 9% cash levels I'm at. And I'm going to find some covered calls to sell on some of these rallies. The problem I have is most of my stocks are still undervalued. I don't want to cap them on accident into a rally. So mostly what I'm going to do is just let my cash secured puts expire, and then those unlock the cash that was holding them. And that's what will probably bump my cash levels back up to around 20% come the March expiration. Don't have much expiring in February. I had a bunch expire in January, and I'll have more expire in March. So as I try to navigate these cycles within the secular trends, it's not about trying to really outtrade the system in the very short term. It's really just about adding a few points here and there with option premium and letting my cash that's unencumbered drift up sometimes so that when the market does correct, I can sell puts on that volatility and suck in 20 and 30 and sometimes higher annualized returns on my cash, on top of the fact that my cash still collects the money market rate. So my cash, which is anywhere from 20 to 40%, is not only earning the money market rate, but as I sell puts against it, gets another huge return. And a lot of those expire. And I just get to rinse and repeat. And I showed you in January what my returns were last year, basically in line with the stock market, but while holding 20 to 40% cash. Wouldn't you like to make what the stock market makes, but with 20 to 40% of your money in cash? It's a pretty nice equation. I'm going to show you one more thing here before I jump to a couple charts. Remember last year I was talking about private equity real estate and higher rates delayed two of the projects that I've been working on. Well, in the Tree Rings report, they talk about the arbitrage that's coming. People moving from the high price cities, maybe back to near where they grew up, maybe to a place that's more climate resilient, whatever. And they use Cleveland as an example, suburbs of Cleveland. 7-bedroom, 8-bathroom house, 10,000 square feet on 26 acres with a private lake and a beach. $2 million. Do you know what you get in California or New York? $2 million, right? Maybe 2,000 square feet on a postage stamp or in a condo. There's a huge arbitrage. It's going to play out over the next 10 years. That's why I have Jolene getting into real estate. I don't really have her doing it. I just said, hey, pick out what you want to do. She picked real estate. And I said, okay, well, here's what's happened. Here's where the niche markets are going to be. People relocating. Her tagline is going to be reload with J-Lo. J-Lo is her name, really. And you're going to see this sort of thing happening. They talk about one of their favorite investments are suburbs and semi-rural communities in second and third tier U.S. cities that should do really well. What have I been talking about for a couple of years now with you? I've suggested that you buy real estate in those areas. This trend is just beginning. You know, when institutions started buying single-family homes, the price of real estate went up. Now imagine what happens as the people moving to California and the big cities turns over, which is what looks like is starting to happen, and they start moving to the interior of the country, especially the Great Lakes region. What's going to happen to that real estate? So what we've talked about today are two things that you may want to follow up on with me. And that is that the banks are starting to loosen up. There's a big shift in real estate coming to climate friendly, lower taxes, nicer places for less money. The house I'm building will probably come in at under $1 million. Will be on an acre of land, 3,500 square feet with a basement, which you don't get everywhere in the country. It has 2 extra bedrooms if I ever need them. So really it'll be a 5-bedroom, 5-bathroom house with about 6,500 square feet livable if I ever want to do it. First floor will be 3,500 square feet. Basement would be about 3,000 square feet. But the basement will have windows because one side will be exposed. Can you do that in California for $1 million anymore? Even Texas, the prices are going up. Florida, can't do it in Florida anymore. And Florida and California have big climate problems. And while Florida currently has super low taxes, cost of insurance more than offsets that. That's what people don't understand. Well, I'm going to Florida because they have 0 income tax. Yeah, but your insurance costs double. Vince says, put in an elevator. Way ahead of you, bro. My elevator is going to go from the basement to the first floor up to the observation deck. All right. I want to talk about emerging markets debt versus treasuries really quickly. This is emerging markets debt. This is treasuries. When you overlay TLT with emerging markets debt, what do you see? Not only is emerging markets debt beaten U.S. debt, it really started beating it a lot lately. And the developed market, the orange line, U.S. debt, has been more volatile than the emerging markets debt. So not only do you get a higher yield with the emerging markets debt, it's been less volatile than U.S. debt, and that's where the growth is. Now, I think that U.S. debt and emerging markets debt are going to play out in similar fashion. It's easier for us to deal with U.S. debt with the treasuries, but emerging markets debt, especially in the countries that adopt Bitcoin, which is most of them, and in the countries that are young and have some technology and or resources, are going to do very well. So while I use this basket, emerging markets debt basket, versus TLT in my 401k plan, what we probably know is that emerging markets they have favorable conditions, along with the United States, are going to be where all the growth in the world is. Where are these emerging markets? Mainly Southeast Asia, but also Africa. The problem with Africa is governance, so it's hard to invest there. Not impossible, but hard. But Southeast Asia is a pretty interesting place. That's why I started buying AIA recently. It looks to me like it's going to break out, because when you put in the other trend line, what do you see? Right? What do we know about that pattern? Is usually there's a breakout. Sometimes there's a breakdown, not outside the realm of possibility, but probably based on history, probably should expect this. What do the charts auto functions say? It's the old one. That's the new one. And remember, AIA has some exposure to China. Well, what do we know about China? Tree Rings talked about that this week too. So a lot of the things that I've been talking to you about, Tree Rings covered this week. And what they really focused on was the idea that China is going to loosen even more, and that the United States and that deal that they've been working on is probably going to help them. So while I have a hard time investing directly in China, I do like Asia in general. And so a fund that gives me exposure to Korea and Japan and Vietnam and Malaysia and Indonesia, but also China, looks pretty attractive right now, doesn't it? So here it is, getting to a spot where it looks like it's going to break out soon. And here is where it's probably going to head, up to this red line somewhere. It's a great asset allocation. And I'll be adding to this in the 401k and subtracting from the developed markets dividend fund that I've been in, because it isn't outperforming and it's too tied to Europe, at least for now. You can buy Europe off of crashes, but they just muddle along. It's very hard to invest in Europe. Great place to visit, not a lot of investing that's worthwhile. Over at FS Insights, he talks about how the S&P 500, right, is getting its rally that I talked about, and that their outlook for the year was probably too conservative, and they're raising their estimates. Remember, my estimate was 5,700 on the SPY this year, and they are going from 5,200, which was already high by consensus, up to 54 to 5,500. Now, he has some fun with that because he talks about the Chinese New Year in the zodiac. And I will show you this just because it's fun. In the year of the dragon, 75% of the time the stock market is up. This is going back to the late 1800s with a 12.7% median. Now, what's really interesting is that the small caps do even better. 88% of the time they win, and they beat the large caps by 6 percentage points. Year of the rabbit's better, but year of the dragon's pretty good. So your dragon, snake, horse, goat, monkey, rooster cycles are generally really good. I don't think that it matters that much, but it's an interesting correlation. But like the Super Bowl indicator that we started with, probably doesn't mean much. What I think is more important is that we go back to the secular trends and we think about how undervalued small and micro caps are right now, and even many of the mid caps. And we take a look at the fact that breadth has been expanding. At the end of 2021, everybody was talking about expanding market breadth as it got from 80 to 85 to 90 to 92, 93% of stocks going up. When we get to the point that 90% plus of the stocks are all going up, that's going to be our signal to do what? Buy or sell. It'll be sell. We've already been buying. Now we have to let everybody catch up for the next year or two. And they'll catch up and they'll create the parabolic move up in the market. That'll be time to take your profit, probably starting by next January, depending on what your situation is, but maybe lasting all the way to January 2026. So while we've been scaling in, I'm telling you to make sure you're fully invested on the next dip. A year or two out, you'll be adding back to cash, because that transition for the clean energy period, and as we deal with the fiscal issues in the budget, 26, 27, 28, 29, it's going to be a transitionary period. And what do we know about transitions? People get frustrated, they get impatient, and they sell. And we should be able to avoid it. And then when things get as bad as they can get and breadth drops all the way back down to 10 or 20%, which is what was happening when only the mega caps went up, that'll be a great time to buy. We don't have to trade much, but we need to be aware of these cycles within the secular landscape. And over the next 6-7 years or so, probably make 3 major asset allocation shifts with tweaks along the way. Those 3 major asset allocation shifts, if we're more right than wrong, don't have to be perfect, just have to be excellent, should result in most people having about, this is historically accurate, 2 to 3 times more money than if they don't make those asset allocation shifts. You can index all the way through it, but if you're close at the peaks and the troughs, which is something that Paul Tudor Jones talks about, just close, you'll end up with 2 to 3 times more money over that period of time for that many cycles. And that's what we're going to try to do. All right, I'm going to bring Shooter on and we will do the major markets review.